Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, March 18th, just after the close, and the first green week in the last 5, maybe the last 6. You're probably tired of seeing me on Fridays coming on with bad news. I have Shaun Burgess, who you know, with me today. Shaun is portfolio manager and trader on our tax-free Muni desk. He's going to share a few thoughts there. Let's pop up a slide that I saw today, a Benjamin Graham quote that the chart report put out. And take a read on that, because I thought it was very apropos with where we sit today. The market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. And that is a very accurate quote that Benjamin Graham had. And we are in the midst of that right now in terms of some of the extremes we saw in negativity, in fear. You know, we do use some of that work, as you know, Shaun, on our equity side, but we can even see that on the bond side from time to time.
Oh, yeah.
Fear and greed.
Yeah.
And we'll speak about that in a moment. In terms of the equity side, very nice to see growth get a bid. Growth has been the whipping boy now.
Haven't seen it in a while.
For, you know, really 6 months versus value. And we've discussed that on these weekly trading reports, and how we've been trying to stay balanced and barbelled, and respected the fact that value can act somewhat defensive in these markets, and that's been helpful. In terms of what we see going forward, I have many conversations with analysts, with clients. Over the last 5, 6, 7 years, Shaun, when we've gotten a steep pullback, we've gotten V recoveries. Think back to COVID, March COVID. Think back to December of 18. You're talking about really punishing drawdowns, which turned around and just went higher. What my concern is there in thinking that this may be a similar situation is those were on the backs of a very loose Fed, providing liquidity to the markets. We're having the opposite of that now, right?
Yep.
And we're going to speak about that. So I just caution anybody that thinks they've missed the market or think the bad news is in the rearview mirror, that we're in a little bit different of a trading situation now. We still have headaches in Russia and Ukraine. That hasn't solved itself. Yes, there's been a bit of talking going on. And now we have the Fed on the front end of multiple hikes, something we have not seen in forever.
Yeah.
So I think we're going to have plenty of opportunities on the equity side. I think we're going to have plenty of opportunities on the commodity side. We talked 2 weeks ago about letting go of some commodities into that crazy rip higher. I'd like to replace some of that. We'll see if it pulls back any further. What about in bonds this week, Shaun? I was excited when I heard you and John and Amy talking about, on the long side of the Munis, starting to see some 3.5s floating out there.
Yeah, you know, for the first time in quite a while, we're looking to dip our toe in, take advantage of some of those opportunities where you can pick up very high quality bonds at that 3.5% or better. You know, on a ratio basis to Treasuries, those are very attractive. And you know, we're not going all in, we're not blowing durations out, but we're definitely stepping in, picking up value where we can, and trying to be opportunistic in the broader market.
We've spoken really since COVID. John has stressed how Cumberland has kept durations, or the net of maturities, how short or long your bonds are in your portfolio is what duration can best be thought of. We kept duration tight, short, with the idea that we didn't want to extend maturities at the kind of rates we were seeing. So we have plenty of dry powder for some of those longer rates that we're starting to see. I mean, when you think about Shaun, a 3.5 out, even if it's out, let's just say 25 years versus a 25-year Treasury at maybe a 260 or a 270,
Yeah.
A 3.5% tax-free after tax. We're talking about 5+ for a lot of people.
Yeah.
That's a lot of value right
Yeah,
there.
I mean, and it's why we're looking to really try to take advantage of those where you can, whether we go higher, whether we go lower, you just need to take advantage of what's in the market. And that's really kind of what we're looking to do here.
Yeah, good.
And being barbelled like we do, the structure, how we structure portfolios, gives us that short end, which we can really move out into the long end to really capture those higher yields.
And it's important to point out when you're talking about some of those longer term bonds, they just are a piece of the allocation in the portfolio.
Yeah,
we're not taking all the money and buying 25-year bonds. It's just out there to try to take advantage of an inefficient long end of the muni market to add yield. Important to note that even at those 3.5%, we're talking about investment grade.
Yes,
Okay.
Very high quality. So, we're not willing to risk or to take on undue risk by going down the credit curve.
Right.
When you don't have to, you can pick up a perfectly good bond, very high quality at that 3.5%. That's a steal, and it's worthwhile to take advantage of, while it's here.
Great. So heading into next week, what we try to talk about within our own firm, within our own shop, within the trading desk is not too high, not too low, what can go right, what can go wrong. Remember to like and comment. We'll try to respond to any comments we get. Everybody have a great weekend. We'll see what next week brings.